before, my name is Luke Laretive. I'm the CEO at Seneca, here with my co-PM, Ben Richards. And we'll walk through essentially all the products, the two funds and then the multi-manager strategies as well for clients. We run these webinars every quarter. Usually, after the end of the quarter, a month after the end of the quarter. We're a bit late this quarter. As I said, it's been a bit busy. But yeah, that's us. The whole thing's governed by our investment committee. And while Ben and I pick stocks and you guys see our faces on stuff, these are the people behind, I suppose, everything we do at Seneca, really, from an investment perspective. If you're not familiar with our business, we run 5 multi-manager SMAs that invest each one in 4 to 8 fund managers within the asset class. And then there's 2 direct investment products. There's the Seneca Australian Shares SMA, which invests in companies from inside the ASX 300. And the Seneca Australian Small Companies Fund, which is open to wholesale investors only. That's a traditional unit trust, and that invests primarily in small companies on the ASX. They're both long only, sort of quality growth focused. To probably be our style and bias. I'm going to let Benny run through the direct stuff as per usual. I'll do the boring multi-manager stuff, which no one's too interested in, and then we'll do questions and Q&A and try and wrap this thing up within half an hour. Benny, over to you, mate.
So, g'day guys. Starting off with the Seneca Australian Shares SMA. We've had a great quarter, generating almost 15% return, which is 10% above the benchmark. So it's really pleasing to see that light blue line tick above the index and the peer group since inception. So yeah, I suppose a good reward for people that have been in the product for a while. Particular drivers this quarter, RPM Global is this mining software provider, which we've talked about on various media channels and to you guys before, but that received a takeover bid from Caterpillar, which is the largest OEM globally that does mining equipment, and essentially they're just bolting in RPM Global's software products, which includes things like equipment maintenance, predictive analytics and those kind of things that they can tie into their own equipment suite. So that's been a really good winner for not only the large cap, but also the small cap. Also contributing was gold exposures, Ora Banda and Ramelius, most notably. Gold price has obviously been on a run. It has pulled back somewhat in the last couple of weeks, but it's just kind of worth remembering that even over the last few months, it's still up significantly from about 3,400 to about 3,900 today. So those are the contributors, detractors. You can see there James Hardy, Ordinate, CSL. We are underweight CSL. So haven't borne the brunt of that as the index has. It's had a couple of disappointing updates in a row now. It's kind of at this interesting valuation juncture, and perhaps more to come on that in time. But we've also got changes there. Coria, this cybersecurity company, which has hit that profitability inflection point, a common theme we've talked about before, and still growing top line at 25% per annum. Regal Partners, HMC, a couple of fund managers that we're pretty bullish on at these prices. And then the outs, you can read them as well. But RPM Global, we have cashed out of that one, given that it has received a cash take of a bit of $5 per share. We've also reduced exposure to gold as well. So given that it has run up strongly, including Bellevue Gold, and we've increased some exposure to the more pro-cyclical commodities. Jump into a specific stock, which for this quarter, I thought we'd go through Imdex. So Imdex is the global leader in drilling technology for mining exploration. And when we say exploration, that's drilling holes. It's not necessarily by pure explorers per se. Could be often developers and producers that are drilling. Imdex is sort of 50-60% exposed to gold and copper, both of which have been the commodity price has been rising quite strongly. And given that Imdex is kind of that dominant number one player in the directional drilling tools, it does, I suppose, benefit in line with the sector tailwinds. It has also increased its share of wallet from customers over time and has resulted in outsized earnings growth over the last sort of several years. So that chart is just kind of showing you that as these commodity prices go up, both in gold and just the broader commodity suite, which Imdex is exposed to, then you get more capital raisings, which is not only good for us as shareholders in resources specialist brokers like Euroz Hartleys, but it also means that these explorers and developers have a lot more cash to put back into exploration, which is a typical lead indicator for Imdex's earnings. Just a really positive data point there for earnings going forward. Also, just got there the correlation, I suppose, between gold price and Imdex share price. And on the right-hand side there, just something I thought was kind of interesting this week. We've seen updated presentations from a couple of those gold producers that are building out their project pipeline, I suppose, and doing a lot of drilling. And yeah, Greatland Resources, which is acquired the Telfer mine off Newcrest, Newmont. And they're stepping up a lot of drilling into FY26. And same goes for Ora Banda, which has always been a exploration-led story, but even particularly just on the back of stronger cash flows, they're able to invest a lot more money into the ground. Onto the Seneca Australian Small Companies Fund. Also a strong quarter, 17.4% over the September quarter, added a couple of percentage points of alpha. Yeah, I mean, I suppose numbers speak for themselves, but just to talk to the portfolio, also RPM Global, also gold exposures like Ramelius. Emeco is another top holding in the fund, which has traded so it's a mining equipment rental provider. It's traded a large discount to NTA, the net tangible asset backing of that mining equipment. It's sort of probably bought a position in about the 70 cents range. It has traded up to about $1 just on better operational performance. And then it comes out in the last couple of months that it's a takeover target, rumored to be at least. So look, we'll see what happens there. But you'd expect any takeover bid to start at least at NTA, which is still $1.36 and growing relative to $1.15. I think is the last traded price. So still really like that one. Detractors, VBX has pulled back from its strong RPO performance. Is a bauxite developer up in WA. Ordinate, we've written about in the media. HMC Capital has also pulled back a bit, and it's another one we really like. It's the property and alternatives fund manager. In terms of what we've done to the portfolio recently, some similar names as the large caps. I suppose a couple of things to call out here. Stanmore Resources we've added back into the portfolio. It's a metallurgical coal producer in Queensland that we think is trading at bargain prices. Exited, we've gotten out of Infomedia, which also is another software company that received a takeover bid. GQG, sort of momentum has turned and they're receiving outflows. And the guru to my right here was able to execute that sell trade prior to their downgrade where they admitted to having some fund outflows. So did well to get out of that one. And Vault Minerals, we took some profit in a couple of gold names, as I mentioned. So yeah, dive into a stock in the small companies fund, which is AIC Mines, which gained 23% as copper prices strengthened. But why specifically do we like AIC in the copper space over some of the other names? Well, it's got a really good production growth outlook. It's a high quality cornerstone asset with another quality growth asset, which is high grade copper up in North Queensland. It's well managed. You've got Aaron Colleran and the team there that have largely come out of Evolution Mining, which is a large cap gold name on the ASX. Operates in a good jurisdiction, and that chart just kind of shows you that it's really, we think, undervalued relative to peers, especially for growth in production, and yeah, it kind of flies under the radar relative to some of the larger names like a Sandfire and a Capstone that are kind of well held by other fund managers. So strong perform, but still pretty undervalued in our opinion.
All right, multi-manager time. Get excited. All right, so Aussie equity strategy, pretty, really good quarter, to be honest. 5% outperformance at a 10% quarter. Small caps doing well. Seneca shares doing well. No major changes to manager weights or anything there. And yeah, that strategy is kind of going fine. Still got a little bit of catching up to do since inception with our sort of overweight position since we started, but that was when large was outperforming. And I think everyone can see now what's happening with smalls and how quickly they can kind of catch ground. We don't own the Seneca Australian Small Companies Fund isn't part of this strategy simply because it's not a retail product. It's only available to wholesale clients. So we have a couple of other Aussie small cap managers, and Spheria was the sort of best performing of those during the quarter. But yeah, the Aussie Shares Fund, a large cap strategy, also doing well, as you sort of saw. Global equity SMA has been a bit disappointing. It's clearly underperformed the benchmark and the peer group during the quarter. Our underweight to US large cap equities, where we see sort of extremely stretched valuations and a tech heavy kind of benchmark, sort of weighed on our performance, because the S&P 500 was kind of a key driver of benchmark performance. Disappointing, I suppose, because our relative overweight to Asia and emerging markets was the right call, with sort of 9.7% performance versus sort of 6 elsewhere in that. But our manager selection really let us down. FSSA mildly underperformed, and GQG was kind of significantly under benchmark with their kind of quality defensive tilt. There was a similar story in SMID, which is kind of our global small and mid caps, which is kind of our other major tilt in this strategy. Both managers underperforming, and it's really been a value and discounted stock led and not a quality kind of driven rally in global SMID. And I've got a slide on that in coming up. Aorus and PM Capital both did quite well for us relative to benchmark. Nothing too much to report, and the Aussie flat. So a bit of frustration here for us at the moment. We're working through it, but I don't think there's a lot of justification to change course. And part of my rationale here is this chart, and I'll thank my friend Stephen Bird from Canaccord for flicking this one through to me. But it's essentially a chart of relative performance of high ROE, or let's call them high quality companies, to low quality companies in the global small and mid cap segment around the world. And you can see where I've chucked the little red circle on. We're at a 1 standard deviation relative, I suppose, underperformance, which is quite rare for high quality companies. So while our active managers in the space haven't been doing well in the last quarter, we can't see that lasting for too long, and we think it'd be a mistake at this point to shift away from that allocation, because we think, as we've kind of explained kind of ad nauseum, why smalls and why emerging markets relative to large cap US makes sense. So as much as it's frustrating and we don't like to underperform ever, it's part of making calls, and particularly in this kind of larger macro part of the economy, you're never going to get, or the market I should say, you're never going to get these economic calls right on the day. So it's always about getting them right in the aggregate. And I think we've got really sound basis for what we're doing. And whilst I'm not happy with the current outcomes, we're really pleased with the strategy overall. Aggressive income's going quite well. As you can see, we had a period of underperformance as the markets kind of ripped higher. This strategy is sort of much more of a stable income focused strategy. So with 50% of the benchmark linked to markets, sometimes it's going to look bad. Markets have pulled back, strategies sort of maintained where it's at, and we kind of had a decent last little month with sort of 3% alpha, catching most of that back up. We're only fractionally under for the quarter, and certainly ahead over the year still and since inception. Spinning off really good yield, generating good returns, doing what it's supposed to do, and get you kind of benchmark-like returns, but mainly from income and other alternative sources. We've really made one change recently, which is post-quarter, but I thought I'd update you anyway. We've reduced our exposure to metrics and replaced that with MA Financial in one of our strategies. Similar private credit exposure across both strategies, but diversifying our manager risk there. which we think is prudent. Overall, though, we've got quite low exposure to private credit as an asset class more broadly. Defensive income, I've actually got no notes here to talk about. It's doing exactly what it's supposed to do. Really good income, sort of 6% plus income, low volatility, really good returns like for relative to benchmark. So that's doing what it's supposed to do. It's not very exciting or huge numbers, but for multi-generational, ultra high net worth families, and those focused on generating reliable income in retirement, this is exactly the kind of product you want to be investing in. Absolute return, I was really pleased with this month. We've had 2% alpha for the month, 3% alpha for the quarter, and our sort of persistence, I suppose, with diversified futures finally paid off. We've been talking about it for 2 or 3 quarters now. The relative underperformance there, and as our CPI plus benchmark never goes down, it's a pretty tough benchmark to keep up with. But I'm confident that we can get back above there with sort of one more decent quarter. As much as the chart looks bad in the sort of the way it's zoomed into quite small increments, we're only 2% behind benchmark, and as you can see, we had 2% alpha in the last month, so it doesn't take much here to swing around and catch up. And yeah, I'm kind of expecting that to happen with some more sort of easier follow trend markets sort of at the moment for those managers, and they typically do mean revert over time as well. So it's a again, you just got to sort of not throw the baby out with the bathwater or get too reactionary. Try and keep it calm, and I think we're not far away there either. From an outlook perspective, we've kind of covered most of these points. Equities, it's really about small caps and emerging markets in our view, being away from the Mag 7 or Mag 10. I don't know what the current acronym is, but there seems to change every other month. But that's kind of the tilts in the macro. In the micro, from a portfolio perspective, we're getting pretty interested in some mining and some of these pro-cyclical names that Benny talked about. Iron ore, copper, bauxite, lithium to lesser of an extent. I think look pretty good at the moment, bottom of the cycle stuff, and we're seeing plenty of opportunities there. In fixed income, there's still really good yields. You're looking at 6, 7s for defensive stuff and kind of 8+ for the stuff with a bit more credit risk in it. Really good alternatives there for retirees and those people who are focused on income. I'm not really sure why you'd be buying equities at these kind of yields when you can take a lot less risk in a bond and get paid like that. From a macro perspective, our view on Aussie rates is, I don't know if it's changed, probably changed, is maybe a bit strong, is changing, thinking about it. Mate, it's on our minds, probably the big $1 million question for us at the moment. Stubborn inflation, rising unemployment, maybe, TBD, we've probably got to see some more data, but not a good mix. And certainly, we see some sort of structural issues with productivity and kind of borrowing from the future and, asymmetrically benefiting asset owners over wage earners. And I think while we do that, we're going to continue to run into these productivity crises in Australia. The big sort of swing factor, I think, in the markets that will really make it, rip is China or other emerging market related kind of accelerations in growth, whether that's from sort of fiscal, monetary stimulus, or, as is common in China, just other kind of shadow policy that drives up demand. And I think that's going to be good for commodities, emerging market equities and fixed income and ASX kind of more broadly. So yeah, that's kind of where we see things at the moment, and yeah, how things are sort of playing out at Seneca. On time for range, Benny and I are happy to both answer questions. We'll do 10 minutes of Q&A. Try and avoid just rattling off, what do you think of XYZ stock? We're not going to go through every stock in your portfolio, but we'll do our best to answer a few questions and cover things off. Let's see if anyone's been brave enough to ask a question. Is there anything in here? to see. I'm hoping you guys can ask questions and it's not locking you out. So there's no way of me really to know. Oh yeah, here we go. So I was thought, here we go. So what is our outlook on E-Road from Leon? You want to do it? You want me to do it?
I can do it.
Oh, I can do it. You can do it. It's fine. There you go.
Well, outlook on E-Road. I mean, I suppose you're obviously referring to they had a trading update recently, which highlighted a large US customer churning. I suppose it's worth noting that they've got the US, they've also got New Zealand and Australia for their fleet telematics and software business. It's a business that was originally born out of New Zealand, and that's where it's got the strongest market share and the strongest margins. Our view has always kind of been that the US is probably more competitive and less attractive return on capital for E-Road. Therefore, I suppose them allocating capital away from the US and into this core New Zealand and Australia opportunity, which has kind of been catalysed by this E-Road user charge, which is a way for governments to tax road users, but more fairly when there's more electric vehicles in the mix rather than just petrol cars. And that's a really big growth opportunity, particularly in New Zealand in the near term, or I suppose the 18-month outlook. So we actually think, although it's obviously a negative that you've got a small revenue downgrade, which when you're at this profitability inflection point leads to an outsized downgrade to earnings. I suppose the key is that from a return on invested capital basis is that we probably prefer them to make that strategic move. And
I think it's pretty consistent, like with their stated strategy. And ideally, you don't want to lose, existing customers at unfortunate times. You want to obviously retain all your customers and then add more. But as part of focusing on Australia and New Zealand and kind of essentially exiting the US over time, you're going to have these occasional kind of hiccups. Now, it can be a short-term thing or a long-term thing. I think in this case, it's consistent. So no, our outlook for E-Road's fine. We're pretty cool with holding it and owning it. I think it looks pretty good here. And yeah, like there's no real dramas for us at the position, at the weight that we've got in the portfolio. So yeah, Leon, happy with E-Road. What are your thoughts on the new REC next gen? REC, I'm assuming you went good research, Wayne. I don't know about tanking. I think it's just ripped on commodity prices, and then it's just back on commodity prices. I think uranium's looks pretty good long run. I think it's probably the best asset on the ASX. We know the val isn't cheap, but I think you've got to buy the best asset. So most likely to get a takeover. Yeah, we like next gen a lot.
Yeah,
we talked about it this morning.
I think with uranium, you've just got to bear in mind how the spot market, there's not that much volume traded relative to the term contract market. So you often hear about, people that work in uranium companies talk about that disparity and where you can't really read too much into the spot market. But obviously the spot market does, for those incremental extra tons that are being traded in the market, does move around quite a bit, and therefore the equities can be fairly volatile. But yeah, I suppose it's the highest quality asset, and it's our preferred exposure to uranium.
Yeah, pretty easy one next gen, I reckon. What are the implications for Australian small caps if there is a global market correction, particularly of Mag 7 from KT? Implications. Well, I mean, nobody's immune when the market corrects. I think, the US economy in particular seems to be pretty much just riding on AI at the moment and related. So, yeah, I mean, there's a lot of money to come out of there. And in my experience, whilst in the short term, that might spook everybody, money doesn't just disappear. It rotates. And I think, Katie, the more interesting question to ask yourself is, if that happens, where does it go?
Yeah, and you can probably make the same argument or discussion with CommBank, like if CommBank was some money was to come out of there, is that bad for small caps? Well, not necessarily.
Charles, is there any reason we don't own Bizarre? Yeah, there is, but we're not going to talk about it on here. So yeah, sorry, I'm happy you're a happy shareholder and making money. Any changes to your thoughts on Greatland takeover? I was hoping this one would come. I love a bit of Antifa Greatland.
Is that a plant question
From Jason Price? No change.
There's updated thoughts.
Constantly. There's updated thoughts. There's updated information. Do I want to tell everyone about it? No, I'm not going to cover it today. But we still think it's going to happen, and we think it's going to happen soon. Hi guys, it's your first time checking in. Mark, thanks for coming along. Thoughts on energy sector, any small cap opportunities you're tracking worth chatting about? Wind, solar, bat storage, etc. I wouldn't say wind, solar, battery storage. I would say I think the energy sector is maybe the best opportunity on the ASX at the moment, but it's not necessarily some wind farm or battery storage project. I think, we own like oils. We think oil and gas exposure looks good. Energy prices look cheap. Thermal coal, lithium and silver, which is, lots of silver in solar panels. I think these sort of ideas are really important to get your head around, and really good opportunities at the moment. We got back from our Brazil trip with Karoon Energy in September, and we learned a heap about sort of offshore oil and gas, and we're thinking pretty hard about that sort of stuff. It's not necessarily in the sexy renewable stuff, but as you guys probably have learned, sexy for us isn't necessarily part of the investment thesis or thinking.
I think there's probably also multiple ways to play it. Like rather than just investing in a wind farm itself, which the economics might not be as favourable, we do own Energy One, EOL, which is the
software trading,
software and services provided to those energy traders, and also another company that does a lot of construction on things like battery storage and renewables. That's probably the way that we're playing it, I suppose.
Yeah. You guys are so, I will, very short term, like, HMC might be one or definitely in the top 3 or 4 from Luke Larative's perspective, ideas we've got at the moment. I think HMC is like a $7 to $9 business, all going to plan. If you're a good research sub, then you've got the thesis. There's 3 kind of problems, I suppose, at the market, and the shorters will get after. I think they're all very solvable, and they're already on the way to solving 2 of them pretty quickly. If you're reading the attention, I think the shorts are scared here, and I think that's justifiably so. So therefore, they're getting in the AFRs here and trying to talk down. If you read the last thing that the AFR printed about HMC, I can only describe it as a personal hit job on people who are really good at making money. So from what I've seen, David DePiller and Will and the team there are pretty good at what they do. And when things don't go well, they're pretty good at getting their hands dirty and getting after it, which is exactly what a good entrepreneur will do. So if shit goes wrong at Seneca, I'm going to be the first one to muck in and get after it. And if I can see that kind of attitude in other entrepreneurs, typically I'll back them in to get it sorted, the same way I'd back myself in to get it sorted. So no, I don't have any issues. Like, short it, please short it. Like, I look forward to taking your money, and I don't know when it's going to turn around, mate, or when it's going to go up a lot, but I'm pretty confident that it will.
Yeah, I think it's pretty weak short thesis, and also you only read about this short thesis once they've already gone down in the AFR. No one was calling this a short at $9. Not that we own stock then, but just for your reference, like, you really only hear about these things once they're already down and they've closed the short position usually as well. So certainly not kind of too concerned on what other people are saying about it here.
Yeah, and I mean, by the core to our investment sort of approach, I suppose, is we do not care about other people's opinions on stocks. We really don't. Like, we just focus on our own stuff, do our own work, and, you know, try and block out as much noise as humanly possible. I think that's been key to any success we've had over the journey, and, you know, it's going to be key to how we invest going forward.
All right.
Any last questions? Last call, 1 o'clock. Get them in. I'm going to do one, maybe two more if they're good. Will's back on he's mega cheap. Any other big funds money buying into it? Seneca, I wouldn't call us a big fund or money, big money, mate. I don't know how much stock you think we own.
You wouldn't be surprised as to how much the big funds read into what we're doing, though.
I don't know. I don't know, mate. I don't know, and I don't care. Look, last I heard, there was one other fund who has started buying it recently. I'll spare them revealing them on the Seneca webcast to 69 people. But yeah, there's one other fund much bigger than us I heard who are buying it. But yeah, let's just say, like, we're very confident with HMC. We've got no issues with it. All right, it's 1:01. If there's no other burning questions, thank you everyone again for your attendance and coming along. We really appreciate it. We're always, shocked and surprised when people want to come and listen to us talk about stocks and what we're doing with our business. It's come a long way in 8 years. So thanks again. If you've got any dramas, just email me. Happy to chat. And thanks again.
Thank you, guys.